Markets love to climb the wall of worry, and the question on everyone's mind is, was last week's rally real? Because the market posted one of the best weeks of the year on the back of less than stellar data. So today we're taking a look at the raw data, some key levels, and the biggest stocks in the world to answer the question, are the lows in for 2023? Hello ladies and gentlemen, welcome to the Daily Recap Show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. On the back of last week's stellar rally, we had another green day, mostly on the back of technology and communication services. Microsoft and Apple led the charge higher, but we saw quite a bit of selling from energy, real estate, basic materials, utilities into the big healthcare names, comm services, and technology. And this was also on the back of rates. Rates on the day marginally went higher, but if you look at it on the month, they actually are lower, and based off last week, they came significantly lower. Now, looking at the week ahead, we actually have a very light week of data. Really, we just have a couple of the Fed speakers speaking. Then we have initial jobless claims on November, consumer inflation expectation on Saturday, but a very, very light week of data. And the same is true for earnings. We did have Berkshire report on the weekend, a fairly average report. Buffett's hoarding cash, we know that. But we just have a couple of these smaller tech, high growth names. We also have Uber reporting, Rivian. Generally speaking, these smaller names that are, poised for growth. But the SP 500 has reported year-on-year earnings growth for this quarter of 3.7%, which is the first year of earnings growth reported by the index since Q3 2023. So we've been in an earnings recession, and I got some data here for you guys. The best performing sectors for this quarter is comm services, consumer discretionary, and financials. And I posted this on X on Twitter. Go ahead and follow me, guys. So 405 S&P 500 companies, 85% of the total, have reported Q3 earnings, showing a 4% EPS beat compared to consensus, which is twice the typical beat rate, as you can see here and here. Q3 consensus earnings per share estimates is at 58.22, which implies 4% year-on-year growth, making it the first positive quarter in a year. Excluding energy, earnings are up 10% year over year. Now, the reason why we're seeing growth for the first time is because we were in an earnings recession. Now, a recession is defined as a fall in GDP for 2 consecutive quarters. When you look at earnings, this is the 3 most recent quarters. We actually had negative earnings growth in these quarters. So this is Q2 2023, Q1 2023, Q4 2022. So this is Q4 right here. Now, we actually have seen 3.7% earnings growth in the index this quarter, which is really, really good, and 10% if you exclude energy. If we actually go back to this chart, we can see that energy is the worst performing. It's really weighing on the entire index. But what about future earnings? FactSet released this data right here, and for the forward 12-month earnings per share, they're looking at $241, which would be an 11% growth year over year, and actually an all-time high. Earnings for the S&P 500 are moving the way you want it to move. They are moving higher, but that's all going to depend if these forward estimates actually materialize. So if you're a bull, you're looking at charts like this and saying equities based on where they are right now look really, really good if these estimates hold up. But you'll also be looking at stuff like equity risk premium. And you'll be looking at charts like these and saying, if I put my money in bonds, I can get 5%. But if I put my money in stocks, I could probably get 2% extra on that. Is it really worth it? Maybe if you buy, a really high quality company with a good balance sheet and you maybe get it at fair value. But this will go up if rates fall. And when will rates fall? Well, according to the latest Fed Fund futures data, we're going to get our first rate cut in May 2024. That's going to come in as early as May, and we're also getting 4 rate cuts in 2024 instead of 3. We're looking to bottom out around the 4.2 level right here, maybe the 4.1. Looking into mid 2025. And this is great news for stocks, and here's the proof. After the Fed is done hiking, normally in 12 months we get a 14% return 80% of the time, and in 6 months we get about a 5% return 60% of the time. Very, very positive stats here for the bulls, and this is one of the reasons why I was very, very bullish. We have seen rates topped out in the interim. Adding on to that, we also had a gamma flip. We were in negative negative gamma for the last 3 months. We are now in a positive gamma situation. And pretty much what this means is when you're in positive gamma, option dealers will buy weakness. So they'll buy low, sell high. In negative gamma, they'll sell into weakness or buy into strength. Let's have a look at the last few times we had a gamma flip. We could see right here, March OPEX, we actually had a gamma flip. We went from negative gamma to positive gamma, and we had a huge rally. Then we had a gamma flip in September from positive gamma to negative, and look what happened. We sold. And just around about here, we actually had a gamma flip from negative to positive. What does that mean? Positive gamma is attractive as stocks outperform in market rallies and diversify in market stress. What this means is that it's going to compress volatility at the ranges. Essentially, if you're buying low, selling high, you're compressing where the market can move instead of selling into sell-offs or buying into huge rallies. Let's go into seasonality. So what happens when October is lower after a very strong year to date? Normally, when we've had a year to date return of positive and a negative October, we normally return 4.8%, 88.9% of the time in the last 2 months of the year, November and December. But we already went up 5% last week. Let's dive a little bit deeper into the data. So let's have a look here. 2009, all right, we had a 14% year-to-date return and then a 2% low in October. Very, very similar to what we're seeing right now. We've had about a 15% run up in the SP 500, about a 2% low in October. Normally we see November return about 5.7% and then into December 7.6%. Let's have a look at 2020. Year-to-date return 1.2%, not similar. October negative 2.8%, but then we did return 10.8% in November, 14.9% into December. And the same is true for 1955. We had a 17.7% year-to-date return, 3% down October, very, very similar to what we saw. November return 7.5% and in December 7.4%. So you can look at these and play the probabilities. But what about intra-month? We are here right now. We're probably going to see, very, very range-bound activity for the next 7 days, for the next 5 to 7 trading days in November. We are already positioned long for the end of year run, and all we got to do now is weather the volatility storm. And our game plan, and I bring this up every single video, our game plan was we're going to be buying these levels after the 2nd of November. And that's exactly what we did. And I'll show you on the charts. So this is the year-to-date chart. This was our key support zone right here. And these are the key levels we were looking to achieve, and we hit them all in a week. I really didn't think we were going to hit them that quickly, but the markets are completely irrational, and that's exactly what happened. Breaking it down further, we went into the zone, we bought, and then like clockwork, we hit these levels. And now we're right here. Now where to next? Quite simple. For this entire week, we do want to stay above the 4339 level right here. Okay, we are in a pretty heavy positive gamma zone right here at 4375. Up until the end of this week, if we stay above 4339, it's going to be very, very constructive for bullish activity further into 4425 and above. So right now, the goal is just to stay above 4339 into this week. And then as we look to next week, max paying the monthly OPEX. The plan is intact. If you guys do want to take profit, go ahead and do that. But I would still say that there's still quite a bit of upside left in this market through November into December. Now moving on to dark pools, there wasn't much in the way of dark pools. All the charts looked like this. There was just some huge trades coming in at the close. As you can see right here, there's just some huge support levels all the way down in the Qs, in the SPY, in the IWM. So I wouldn't fight the trend right now, guys. We are in positive gamma. Dealers are going to support any move downward. We're probably going to continue the rally, even if it is just a churn slowly into max pay next week. Take profits where you can. Stay the course. If we do dip and you do see something attractive, especially in individual stock names, buy accordingly. But as it stands right now, there's a lot of support on the way up. The markets are, moving higher. Don't fight the trend. Thank you so much for watching, guys. If you like this video, give me a like, comment, subscribe, share this video if you can on Twitter, on Facebook to all your friends. I love you guys.